Today's presentation is going to be focused on the updates for taxes for 2025. And the presentation is going to be mainly targeted for those individuals who are live-in IHSS providers. My name is Eduardo Iniguez. A little bit just about myself. I'm a professional tax preparer. I've been doing taxes for over a decade now, and I specialize mainly in the tax preparation for IHSS providers, and also as well for those who are providers under the self-determination program. So that's my specialty. And just like many of you, those who are in attendance, I am also a father of two children with disabilities. So I'm right here with you folks as well. So today's agenda, we're going to be discussing several topics, but we're going to mainly target the basics right at the beginning with IHSS. We're going to discuss what are the tax regulations behind the IHSS program. Then after we discuss those basics, we're going to move forward and talk about the tax updates that we have for this 2025 tax season. And many of those changes came with what we call the One Big Beautiful Bill Act that was signed into place this past July, and that it took effect actually beginning with this tax season for 2025. So some of the main areas that we're going to be covering are the updates in regards to the tax credits. There were several modifications that are going to benefit a lot of our families. And also there were some other changes when it came to tips for those individuals who work in industries where it's customary to receive tips. So you're going to be receiving a great benefit beginning with this tax year. Also, for those individuals who occasionally work overtime, there's a new set of rules. So we're going to be discussing those changes as well, and other new forms of deductions that were also implemented with this new act. So we're going to get into details in a few more slides. We're going to be discussing how these changes affect you as a service provider, how you can basically take advantage in right here, take advantage of these new laws to benefit the result of your tax return. And towards the end of the presentation, we're going to be going over some guidelines for retirement, some of the special tax regulations for IHSS providers. Obviously, they do give you a lot of good tax incentives, but at the same time, it also creates a little bit of problem. And those problems are mainly in the area of retirement. Some of you folks are going to be having a little bit of difficulty in the future when it comes to Social Security benefits, more specifically. But we're going to go discuss that area into a little bit more detail as we get towards the end of the presentation. So let's get started with the IHSS, the tax regulations. Here at the top, probably you notice that I'm mentioning IHSS and also self-determination programs. The special rules for taxes that apply to IHSS, they almost identically apply the same way to the self-determination program. So that's why I'm mentioning two programs. The two programs right there is almost again, one set of rules apply almost equally to both programs. So we typically hear that the IHSS the wages that we receive as living care providers under the IHSS programs, that they are tax-free. And it is true as long as you meet certain requirements. But you also need to keep in mind that there's more than one type of tax. And to be more specific, here in the state of California, we typically need to pay 5 different types of taxes on our earnings. The first set of taxes that we need to have in mind is the federal and state taxes. Those are the first two, like I mentioned. The third and fourth type of taxes are the Social Security tax. For those of you who are IHSS provider, your pay stubs does not say Social Security tax, it says FICA. So pretty much means the same thing. The fourth type of tax is the Medicare tax. And the last tax out of the 5 is the SDI, that stands for State Disability Insurance. So those are the five different types of taxes. Now, in order to be exempt from all five, you need to meet two requirements. First requirement, you need to be a living provider. So you, care provider and care recipient, need to live under the same household. If you meet that requirement, you're going to be exempt from both federal and state taxes only. So that particular set of rules is the one that we commonly hear when it comes to IHSS and self-determination. But keep in mind that that special rule only applies for the federal and state taxes. In addition, if you want to be exempt from FICA, which is the Social Security tax, Medicare, and SDI, the other requirement is that you must be the provider for your own children or your spouse. So if you provide your services to either one of these two, that's going to make you exempt from pretty much all five type of taxes. On the second screen, this is another example. If you happen not to be the care provider for your own children or your spouse, you will only be exempt from two out of the five taxes. You will be exempt from federal and state taxes, but you will pay the Social Security tax, Medicare, and SDI. So it's very important that you keep in mind these two different set of rules because depending on who you're providing your services to, it's going to determine if you're going to be exempt from all five taxes or only two of them. And also just keep in mind if you're not a living care provider, there's no special rules that applies to you. Your income is going to be considered regular wages, which means that you're going to have to pay taxes on those wages. So the example that you see the form that you see on screen is the form W-2, the one we typically receive to file our taxes. This is an example of how your W-2 should look like if you're a living care provider. And you primarily need to focus on not all of the boxes that you see on screen. You need to look to pay close attention to box number 1 and box number 12. In box number 1, if you're a living care provider, that box should be 0. You shouldn't be your wages none of your wages will be reported in box number 1. Instead, they should be recorded in box 12A. And right there underneath where you see the 12A, there's a special code. It looks like a number 11, but in reality it's a double I. That little code right there means or notifies the IRS that your wages are recorded right next to it, that they are tax exempt. So this is the proper way, the proper way for your W-2 to reflect your wages. Box number 14 that you see right here, also highlighted right in the middle. That's the acronym that you see right now. That stands for qualified overtime. If you're a living provider, the no tax on overtime rule that just came out with the One Big Beautiful Bill it does not apply to you. So basically, once again, if you're a living provider, you can completely ignore the number that is being recorded on box 14. Again, that rule does not apply to you. It only applies for wages that are considered regular wages subject to taxation. Now, if your W-2 looks like, again, like the one on screen, you can essentially, you have the option, well, not the option, but you're not obligated to report this W-2 on a tax return. There will be no consequences with the IRS if you decide not to report it, again, because you're not required. For IRS purposes, anything that is shown on box number 1, it is considered regular income. So if your box shows 0 wages, the IRS doesn't really care about this W-2. So just keep in mind, you're not required to report this W-2 form on a tax return if box number 1 shows 0 wages. But keep the following thought in mind. Even though you're not obligated to report this W-2, if your only source of income is from IHSS and you have children that are younger than 17 years old, It will be beneficial for you to file a tax return even though you're not required to. The reason is because by reporting your IHSS wages, the IRS can consider these wages as earned income for purposes of refundable credits. So that basically means that you can receive up to 1,700, where we're going to discuss a little bit more into detail about what the child tax credit is in a few more slides. But you can receive up to 1,700 per dependent that are younger than 17 years old. So once again, even though you might not be required to report this W-2 on a tax return, it could be beneficial if you have children that are under 17 years old. Moving forward, if this is your if you receive a W-2 that looks like the one on screen, more specifically, let's look at box number 1. Wages are being recorded in box number 1. So if your W-2 looks like this, then you're kind of obligated to report this W-2 on a tax return. By reporting it on this W-2 on a tax return, it doesn't mean that you're going to be paying taxes. This is where your tax preparer is going to come in, and hopefully your tax preparer is knowledgeable about the rules behind both the IHSS program and self-determination. If they know, again, if they're familiar with these rules, they will be able to within their tax software to exclude the portion recorded in box number 1 from taxes. So in this example, if this were your only W-2, the full 37K will be reported on the tax return. And assuming you don't have any dependents, the worst case scenario is that the result should be 0, no refund and no balance due. But again, the example that you see on screen is basically the IHSS office erroneously recorded your wages in box number 1. And that usually happens when the form that is called the 2298 is not on file. For if you're not familiar with what Form 2298 is the form that you need to submit to the IHSS agency to basically tell them that you're tax exempt, that you're a live-in provider. So most of the times when that form is not on your file, that means that they will be recording your wages on box number 1. So if this is your case, my suggestion would be to reach out to the IHSS agency and let them know, either submit the Form 2298 and so that they can the following years record your wages in box number 12A. So so this is an example again. If your W-2 looks like this, the one on screen, you are required to report this W-2 on a tax return. Now, on the next few slides, we're going to see an example of how your wages should be recorded on your actual tax return. Just a little disclaimer here. The next couple of slides that you're going to be seeing does not represent a tax advice. It's just for informational purposes only. The examples that you're going to see on screen does not represent or guarantee a refund on your personal tax return. Now, this form that you see on the screen is a little bit cut out because it's primarily focused on a specific area, but this is the Form 1040, the main page for the entire package. Now, depending on how your income is reported on your W-2, it's going to determine which line you're going to be using on the Form 1040. You can either use line 1A or line 1D. Now, on this example, your income, your IHSS income, and we're also assuming that this is your only source of income for this example. Your wages are being reported in 1A, and then as we scroll down on the form, in line 8, you're going to see a negative number. Your IHSS wages it must be, actually, let me just switch. This a negative 50,000 that you see right there, it actually came from another form within your tax return that is called Schedule 1. So if you're going to be reporting your IHSS wages, This form, Schedule 1, is required in order for you to be tax exempt, to avoid paying any taxes. So, in other words, if you're reporting your IHSS wages and you do not attach Schedule 1 to your tax return, you're going to end up paying taxes on your IHSS wages. So, in this form, your wages should be reported on line 8S, right there where it says non-taxable amount. And here are a little bit of vocabulary for tax purposes. Medicare waiver payments, that's the federal term for both IHSS and self-determination. Within the tax return, you're never going to find the term IHSS or self-determination. And again, the reason is because both of these are state programs. At the federal level, they're just referred as the Medicare waiver payments. So this is where you're going to be reporting your wages. And once you record them on Schedule 1, line 8S, they could carry over to the main page on the 1044. So again, this is just a simple and quick illustration of how your wages should be reflected on your actual tax return. The actual result or the actual, or yeah, on your specific case might vary depending on whether you have other sources of income. So this is just a clear and basic example, assuming that your only source of income is from IHSS. So moving forward, like I mentioned at the beginning of the presentation, the One Big Beautiful Bill Act was signed into law around July of 2025, and with it, it came many, many changes to the tax code. But out of all the changes that were mentioned in the act, none of them um, pertain to the IHSS or self-determination programs. In other words, nothing changed for these programs. So the same set of rules that we've been applying for the last 10 years, literally, they're still in place. Nothing was updated, nothing was removed, so everything keeps exactly the same. Now, just with any changes in the tax code, there's always, those who will greatly benefit, and there's those other groups who are gonna be receive not that many benefits, if any at all. With the One Big Beautiful Bill Act, the ones that were most affected by the changes were those individuals who are ITIN holders. If you don't know what an ITIN is, an ITIN is a number provided to those individuals who do not have either a legal status in this country or those who are legally present in this country but are not authorized to work. So, in other words, those who are not able, for whatever reason, to obtain a social security number, they are assigned an IT number. And if you're an IT holder or your spouse or even your dependents, unfortunately, a lot of the tax benefits that you were able to claim in the past will no longer be available beginning with taxable year 2025. So let's get going and let's look at some of the major changes for this tax season. One of the major changes was the no tax on tips. So if you or your spouse or any other family member receive tips as part of their normal benefits on their occupation, they can exclude up to 25,000 from federal taxes. So the exclusion of up to 25,000 is per tax return, not per individual. So if you're single, you can exclude up to 25,000. If you're filing married, either in combination of both of you, you can exclude up to 25. So again, 25,000. So once again, is the 25,000 limit is per tax return. And typically the type of occupations that are going to benefit from this new tax law are going to be those who mainly work in the service industry, like waiters, bartenders, valet parking, and even some barbers. those kind of occupations that typically receive tips as part of their compensation. So in order to qualify for the exemption, you need to receive those tips in either cash or credit cards. And those tips will mainly be reported to you on your W-2. So if you want to exempt or deduct those tips from your tax return, they will be reflected right there on your W-2. So you don't need to basically have like a statement, a yearly statement of all the tips that you receive. No, nothing of that is going to be required. As again, the tips will be recorded on directly on your W-2, and sometimes they can also be recorded on Form 1099 if you're a independent contractor. Independent contractors that could qualify for the tips exemption uh, could be like Uber drivers, DoorDash delivery drivers. If you do like Amazon Flex, Walmart Spark, those kind of jobs, you're considered to be a self-employed individual. So you will most likely receive a Form 1099. The tips may be reported on your 1099, but most of the times is they're not going to be recorded right there directly on the form 1099. You will need to print out another statement. Like for example, with Uber, if you're an Uber driver, they usually provide you a statement of the miles that you drove while you were active on the app, and within that same statement, it will show your tips that you receive. Now, this new regulation will be in effect from tax year 2025 all the way to 2028. So it's only going to be around for a short period of time, unless the politicians who are going to be in place, who are going to be active during 2028, decide to extend this law. They're going to have the option to either extend it or to let it expire. But for the meantime, it's from 2025 to 2028. And once again, if you're an ITIN holder, you will not be eligible to deduct the tips on your tax return. Now, one of the other changes is the no tax on overtime. The no tax on overtime created a little bit of controversy within the IHSS community because many live-in providers, to be honest, I'm not sure where they got this information, but there was a rumor that spread all over social media that said that beginning with this year, tax year 2025, that you are not now going to be required to pay taxes on on the overtime that you work. That is false. That is completely false. So just as a general tip, don't believe everything that you see on social media. It's not always accurate information. So the new law says that if you work overtime, you can exclude up to 12,500 from your from overtime payment on your tax return. Now, unlike the no tax on tips, the 25,000 limit on no tax on tips was per tax return. Here, with the no tax on overtime, is 12,500 per individual, up to 25,000 if you're filing marry filing joint. And overtime, first of all, let's clear out a little another controversy that came out when the law was placed into effect. Many people believe that the exclusion on the no tax on tip was going to apply to the full hour of overtime payment. First of all, let me explain how the overtime works. Usually, you start receiving overtime payment at any time you work either 8 hours on a regular day. So beginning with your ninth hour, that's considered overtime, or after 40 hours per week. So either one under one of those scenarios, you will start receiving overtime, and the overtime rate is usually 1.5 of your hourly base. So for example, if your hourly rate is 20 hours per hour, the overtime rate is going to be $30 per hour. So you get an additional $10 um, of whenever you work overtime. Now, in this example, out of the 30 hours, I'm sorry, $30 per hour that you work in overtime, only 1/3 of it is tax deductible. So in this example, if you work 1 hour, you get paid 30 hours of overtime, only $10 are tax deductible. So you do not get to deduct the full hour paid from overtime, only 1/3 of it. And also with 2025, unfortunately, not a lot. The IRS didn't require all employers to report the qualified overtime payments on the W-2. Some employers were able to make the adjustments with a short notice, and they're reporting your qualified overtime payments on box 14 of your W-2. If you did not receive if your qualified overtime is not reported on box 14 of your W-2, you're gonna need your last year's your year-end pay stub, so the last payment that you received during the year, in order to determine what was your the hours, the payments that qualify for the deduction. So pretty much take the last pay stub to your tax preparer so that we can determine how much of the overtime that you work is gonna be tax deductible. And also, this new law is gonna be in place from 2025 all the way to 2028, and ITIN holders they don't qualify for the deduction. The child tax credit, beginning with 2025, it got a little boost. So the child tax credit is a special credit that you receive for dependents that are younger than 17 years old. Beginning with 2025, the credit was raised up to 2,200 per dependent. Again, they need to be younger than 17 years old. In other words, for 2025, the oldest attained age that they could be was 16 years old. So if they turn 17 during 2025, they're no longer eligible. And obviously, if they're older than 17, they don't qualify either. So they need to be 16 by 2025 or younger. And the maximum amount of 2,200, you will only be able to receive the full credit amount if you have regular wages. In other words, you will need to have a second source of income that is not from IHSS. If your only source of income is from IHSS, the maximum credit amount that you can receive is 1,700. So it is limited, the amount of credit that you can receive if you only have IHSS. Now, this credit again is only going to be available for those individuals who have a valid Social Security number. If you, as the taxpayer, if you have an ITIN, unfortunately, you will not be able to receive the credit. The only exception to the rule is if you're filing married. If one spouse has an ITIN but the other spouse has a valid Social Security number, you will be eligible to receive the credit, the child tax credit. But if both spouses, if both they have an ITIN number, unfortunately, they will no longer qualify for the credit. ABLE accounts. There were some changes to this account. For those of you who are not familiar with what an ABLE account is, it's a special type of account for individuals with some type of disability, which allows them to save up to $100,000 in the account and still be eligible to receive government benefits like SSI. So you can have more than $100,000 in this account, but the first 100,000 they don't count towards your eligibility for SSI. So in prior years, before 2025, the account holder was required to have obtained a disability before the age of 26. So beginning with 2025, that age limit was increase to 46 years old. So this increase in the age limit is going to allow a larger portion of the population to be eligible to open AWOL accounts and save and have some savings and continue receiving SSI benefits. Additionally, the maximum contributions, they were increased from 17,000 all the way to 19,000. And the good thing about this type of account is that basically essentially anyone can contribute towards the limit of the 19,000 per year. So in other words, it is not limited to the account holder to be making the deposits into the account. So if you're like family members or even just close, not necessarily, well, family members and friends can essentially make donations. That's the words that I was looking for. Make donations to you, and all of them combined can add up to 19,000. And also the account. Oh, I already mentioned this. Is anyone can make the contributions towards the account. And let's move forward here to the next update. One of the new accounts of financial instruments, as we refer to it in the world of economics, is the Trump accounts. Now, the Trump accounts were designed to give a head start for our minor children. So you, as the parent, can open up a Trump account and help them save money from a very early age. And before the Trump accounts, unfortunately, a lot of our children were not able to benefit from any interest-bearing accounts, which the reason that they were not able to benefit from this type of accounts is because they were required to have earned income. And obviously, if you're a children, you're not working, so you cannot you wouldn't benefit from any interest-bearing account. So the Trump account, again, were specifically designed for minors and eliminated the clause of needing to have earned income. So, but well, let me go over here some of the basics of the account. The account has a contribution limit of $5,000 per year. So you, as the parent, you can open the account for your children and you can make a maximum contribution of up to $5,000 per year. But you can also have your employers also make additional contributions. So you can essentially, if your employer is going to be contributing towards the account, essentially you could, the limit of 5,000 can be a little bit higher, but in order to go above the 5,000 income limit per year, I'm sorry, the 5,000 deposit limit per year, you will need to have your employer also make the contributions. Now, the money that you're going to deposit within the Trump account is going to be generating interest over time. And the interest that it generates, once your child, once it turns 18, they may be able to use those funds for various purposes. And if if they spend their money under under one of those we call authorized expenses, the earnings from the account are going to be tax-free. For example, I have a very short list right here. The list is actually way longer. If your son or daughter decides to use the money for educational purposes, down payment for their home, or healthcare costs, the interests are going to be tax-free. So they're not going to be paying any taxes from the earnings that they receive over the years, as long as they use it for authorized expenses. The Trump accounts are going to be available beginning with taxable year, calendar year 2026. We still don't have an exact date of when the accounts are going to be available for the general public. We were just told that sometime in June, that's when the government is going to give us the exact date. Most likely, the accounts are only going to be available. Well, there's a couple of rumors, but the accounts are gonna you're gonna be able to open them online. That's a fact. But the rumors are that you may be able to open the Trump account on some of the traditional banks like Wells Fargo or Chase. It is still not confirmed if you're going to be able to walk into a physical bank location, but most definitely you're going to be able to open the Trump accounts online. Additional requirements: your child needs to have a valid Social Security numbers, no 18, unfortunately. And for those children that were born between January 1st of 2025 all the way to December 31st of 2028, you will receive an additional or a bonus of $1,000 from the federal government. And if you want to get that 1,000 bonus right now with your 2025 tax return, there's a special form that you can fill out and turn it in and attach it along with your tax return. That essentially is an application to open a Trump account for your newly born child. So again, if you wanted to, if you had a child during 2025 and you want to receive the $1,000 bonus from the government, you fill out the form, the special form, and attach it to your tax return. Your tax preparer should be able to guide you as how the process goes. But it's a pretty very simple form. It's just the child's basic information, the name, social security number, and that's basically all the information that it's asking for. So it's very simple uh, to apply for these new accounts. An additional changes to the tax code was the vehicle loan interest deduction. So beginning with taxable year 2025, you are going to be able to deduct from taxes the interest that you pay on a loan for a newly purchased vehicle. The limit is up to $10,000 per year. So very important note here when it comes to the 10,000 annual limit. The dealer actually is gonna provide you the exact amount. Well, let me backtrack a little bit. You will only be able to deduct the interest that you pay during that calendar year. So for example, if you purchase the vehicle sometime during the 2025, let's say May, the contract that you're going to be receiving from the dealer, it might show that you're going to be paying, I don't know, let me make up the number, 15,000 or 10,000 in interest on financial charges on the vehicle loan. Just because it say that you pay $10,000 in financial interest, it doesn't mean that you can actually take the deduction for the full amount, for the full 10,000. You will only be able to deduct the amount that you actually pay during the calendar year. So even though it might say 10,000 there in interest, you and if you only pay like 2,000 during the year, you will only be able to deduct the 2,000. So in my experience so far, this tax season, I've seen that a lot of the dealers are providing a statement to the consumers where it actually says the exact amount of interest that you have paid during the calendar year. So make sure if you receive that statement from the dealer, make sure that you present that form to your tax preparer so that you can take the advantage of this new law. Some of the basics. The vehicle, in order to qualify for the deduction, the vehicle must be new. And it must be used for personal purposes. So the vehicle cannot be used for business. So if you have, for example, an LLC or something like that, if you purchase the vehicle under the LLC or corporation name, it will not qualify for the 10,000 deduction. The vehicle primarily should be designed to use on public streets and highways And additionally, the loan must be registered in your name. So if somebody else help you get the loan for the vehicle, and unfortunately you won't qualify. The loan must be under your name. Excuse me. Now, and again, the limit is 10,000. If you happen to pay above $10,000 in interest during the year, that excess, unfortunately, will not be able to carry it forward for the following years. The limit is 10,000, and that's it. Another change to the law was for a credit that has been around for many, many years, but now they kind of tweak it a little bit. The the new credit is called, well, not new credit, but the adjustment was made to an adoption. It says loan, I should say credit. I apologize there. I'm not sure what happened why it says loan. It's a refundable adoption credit. In previous years, it was the name of this credit was non-refundable adoption credit. So by changing the name, it also allows the taxpayer to pretty much be refunded the expenses associated with the adoption of a child. So the basics about this credit, you can receive back up to 17,500 in expenses associated with attorney fees and also fees associated with the courts, administrative expenses. So the key component of this credit is that you must have out-of-pocket expenses for purposes of the adoption. If you didn't have any out-of-pocket expenses, you will not qualify for the credit. And the credit applies for adoptions for both national U.S. citizens, children, and also for international adoptions as well. Now, up to this point, we have covered some of the basics, some of the few changes that were made by the One Big Beautiful Bill. I just went over some of the ones that I believe that I could benefit our community. So again, there's plenty more, but many of those other changes were designed for business owners, big corporations. They only gave a few benefits to the rest of the working populations, and we just went over some of the most popular ones. So now let's change gear for a second and let's focus on some strategies for retirement. If you recall at the beginning of the presentation, I mentioned that there were 5 different types of taxes. One of them was the FICA, the Social Security tax. That tax is the one that we all individuals need to be paying throughout our working years in order to be eligible for Social Security benefits once we reach the retirement age. So some of you who are living providers for your own children or spouse, unfortunately, you're not paying the Social Security tax. And if you're not paying the Social Security tax, your benefits once you reach retirement age are going to be very small, very minimum, or probably you're not going to receive any at all. So it depends on your work history. If throughout your life you didn't due to the circumstances of your family, you were not able to work in a traditional job, again, probably you have not been funded your own benefits. So let's focus on the benefits section for a second here, and then let's look at the what are the basic requirements in order for you to receive Social Security retirement benefits. So the basics, in order to qualify for the benefits, you need to accumulate throughout your life what the Social Security refers as credits, which are essentially like points that you get for paying into the Social Security system. So you need to accumulate up to 40. So that's the minimum requirement in order to be eligible. Now, the way it's also the system designed is that you're only allowed to earn up to 4 credits per year. So that's the maximum that you can earn. You can earn less than 4 credits, but you cannot earn more than 4. For 2025, to earn 1 credit, you needed to earn at least $1,810 throughout the calendar year. So it could be on you could have received this amount in a single payment or multiple payments throughout the year. But the point is that you earn at least the 1,810 to receive 1 credit. If you want to receive the 4 credits, you needed to earn 7,240 in the entire calendar year. These numbers, they get adjusted every single year, and once again, this is for 2025. Now, assuming that you earn the maximum allowable amount of credits per year, that means that you at least need to work a minimum of 10 years in order to reach the 40 credit minimum. And again, you need to pay the Social Security tax, the FICA, in order to receive the credits. If you're not paying the Social Security tax, you're not accumulating any credits at all. And just here for reference, the national average benefits for 2025 is 1,976. That's the average amount of monthly benefits that retirees are received during 2025. And the actual the actual amount of income that you need to have in order to receive the national average, it's it's kind of tricky to give you an exact number, but at least you should have continuously worked um, full time and at least receive the minimum wage throughout several years in order to qualify for the national average. The more income you earn over the years, that translates to a higher monthly retirement benefit. The less you contributed, the less you're going to be receiving in monthly benefits. Now, ideally, you should be receiving your Social Security benefits, even if the amount that you're receiving is very, very small. The reason is because even if it's a small amount of benefit, that's going to be a benefit that you're going to be receiving for the rest of your life. So at least I try to encourage all individuals to work towards their retirement benefits, to be eligible and to receive, like I said, at least a fixed amount every single month for the rest of your life. Ideally, you should be also contributed on the side to your own retirement funds. You should be focusing on opening your own individual retirement accounts, and the most popular ones are there's many accounts that you can open and benefit from, but the ones that you're seeing on screen are the most popular ones. The most popular one is definitely the 401k. But this type of plan, it's only provided by employers. So if you want to have a 401k, you need to work for a company that offers the plan. Um, m- most are, Most often you see the big companies like Amazon, Walmart, Target. Big companies like those are the ones that typically you will see a 401k. Yes, there are some small to medium-sized companies that could also offer a 401k, but keep in mind that it is not mandatory for employers to offer this type of plans. Now, the good thing about 401ks is that in many cases, employers can provide what is called the matching. That essentially means that for every dollar that you contribute towards a retirement account, your employer may also contribute either another dollar, 50 cents, 25 cents. It's up to the employer. And in some cases, they don't do any matching at all. But that's one of the main highlights about a 401k, that you could essentially receive free money on top of what you're already contributing towards your retirement savings. The maximum annual contributions on a 401k, and these are the numbers for 2025, is 23,500 or up to 31,000 if you're 50 or over. If a 401k is not an option for you, either because your employer is not offering it, or if because your family circumstances, you're not able to obtain a job, a traditional job, then your next option is what is called the IRA. IRA stands for Individual Retirement Account, and there's two types of IRAs. You have the traditional IRA, and you also have the Roth IRA. The difference between the two is that the traditional IRA, the contributions that you make towards the account, they are tax deductible. So essentially means that you can write off whatever amount you deposit into the account from in your tax return. The other type is called the Roth IRA. The the biggest benefit from this type of account is that the earnings that you receive over the years from all of your deposits are going to be tax free. So you're not going to pay any taxes on whatever amount of interest you receive over the years. In most cases, if your only source of income is from IHSS, it is suggested that you get a Roth IRA. The reason is because you're already tax exempt as a live-in care provider. And again, is this example is for those individuals whose only source of income is from IHSS. So if you're already tax exempt by default, you do not need any additional deductions. So because the purpose of a deduction is to reduce your taxable income to help you pay less taxes. You as a live-in provider, your taxable income is already zero. So you're not paying anything. And because of that reason, it is suggested that the Roth IRA is the best fit for you. On the opposite side, if you happen to have a second source of income, or if you're married, if your spouse has income, probably the traditional account will be a best fit for you. But again, depending, there's not a one size fits all kind of situation here. It all depends on your financial goals. But either one will definitely help you out on the long run. But it's better. Also keep in mind, the sooner you start with a retirement account, the better. The biggest factor when it comes to retirement is time. The longer you wait it out, the least benefits you're gonna receive once you reach the retirement age. The annual contribution limit, and these are the numbers for 2025, for an IRA account, it's 7,000 or 8,000 if you're 50 or older. For 2026, it's 7,500 or 8,500. So the numbers change. And lastly, under the retirement accounts, you could also consider annuities. Annuities, the oversimplified explanation of how an annuity works is as follows. You're essentially, first of all, the way you get annuities, there are several ways, but the most common one is to acquire it with a life insurance agency. So if you get in a contract for an annuity, you're basically doing a one lump sum payment, and in exchange, you're gonna get a fixed amount of monthly payment for the rest of your life. The mechanics are the same as the Social Security benefits. You will receive a monthly payment for the rest of your life. Annuities are best for those individuals who are kind of fearful that their savings are not gonna last long enough. It's for those individuals who are kind of afraid of outliving their savings. So, and also keep in mind for annuities, in order for you to receive a fairly um, good amount of payment every single month, the deposit needs also need to be a little bit higher as well. But either whatever whichever instrument that you decide to utilize, again, the sooner that you do it, the better. Also keep in mind that with retirement accounts, it is very important that you have in mind the special set of rules established by the IRS, and make sure that you use the retirement account for the purpose that it was created for, retirement. And I mention this because more often than not, I see individuals who see a 401k as their savings account for short-term expenses, like for their vacation, for birthday parties, or something like that. A retirement account is not designed is designed for the long term. It's ideally, the money that you're depositing into this type of account, you should not be touching it until you reach the retirement age. There's basically um, you can withdraw the funds from these accounts at any given time, but there's going to be consequences from the IRS. One of the first consequences is, like, for example, with the 401k, if you decide to pull the funds from the account, whatever the amount is, you're going to be paying a 10% penalty if you are 59 and a half, if you're not at least 59 and a half years old. If you're younger than that age, you're going to face a 10% penalty on whatever amount you decide to withdraw from the account. And on top of that, you're also going to be paying taxes. And I mention this because, unfortunately, in a lot of scenarios, people do not find out about these special set of rules until it's already too late. Just for example, like 2 years ago, I had a client who decided to pull the $200,000 from his 401k. He used it for personal reasons, and when he was shocked to receive a tax form for his 401k at the beginning of the tax year. And he was even more in shock when he found out how much he needed to pay in penalties and in taxes. In his particular scenario, he was considered for IRS standards a high earner. He was making over 100K per year. So he was already in the 22% tax bracket. So at that tax bracket, any amount that he withdraw from the 401k was going to get hit by a 22% um, tax rate. On top of that, the 10% penalty. So this gentleman, um, long story short, he ended up paying 64,000 in penalties and taxes on the 200k that he pulled from the 401k. And as you can probably figure, he was in shock and he wasn't happy about it. But again, he learned the rules a little bit too late. So make sure that you utilize the retirement accounts for the purpose they were created. If you want to have, or if you have short-term or intermediate terms, financially speaking, you need to look into other options. So you need to look into other saving accounts, like for example, the one you see on the screen, high yield saving accounts. So this type of account, the benefits that they offer you is that the interest right now it kind of ranges between 3.5% to 4.5%. They're actually the interest rate is getting lower as we speak. They used to be way higher a few months ago. But again, the beauty of this type of account is that the only thing that you need to do in order to receive this rate of interest is just open up the account and make the transfers. Transfer your money over to the account, and that's it. You don't have to make you don't have to pick any type of investment. Your money is just essentially going to be sitting right there in account and earning the interest rate that was established by the bank institution. Now, the banks that offer the best rate of interest, you're usually gonna find them. They're gonna be banks that you see only over the online, not necessarily the physical banks. The physical banks, like traditional ones like Chase, Wells Fargo, they do offer high yield savings account, but the interest rate that they might offer might be way lower compared to those banks that are only whose only presence are online. So with the high yield savings account, most banks require a low to minimum deposits. Again, you can essentially open an account with zero money, and over time you can add on to this account. Now, with this type of account, you can pull your money from the account at any time without any penalties. Unlike with the retirement account, where you could potentially face a 10% penalty, with the high yield saving account, there's no penalties. But the negative aspect of the of this type of account is that the interest rate may change without notice. So you might open an account today, which gives you a 4% rate of interest. In a few months, it may drop all the way down to 3% or lower, or it can even go up. So it depends on the state of the economy and whatever the bank their terms, whatever terms they decide. So it can go up and down without any notice. So that's kind of like the risk of this type of account. But the benefits also is that there's um, there's no penalty for pulling your money out. Another type of account that you can consider for short-term or medium-term goals are the certificates of deposit, the CDs. They're kind of similar in terms of interest rate as with the high yield saving account. They can range anywhere between 3.5% to 4.5%, but they're getting lower also as we speak. The benefit of this certificate of deposit is that your whatever interest rate you receive once you open the account, it's guaranteed. But the negative aspect is that your money is going to be locked in for a certain period of time. You usually get in contract, it's a contract essentially with a certificate of deposit. You place your money in contract for periods of anywhere between 3 months, 6 months, a year, or 2 years. And during that period of time, technically you're not supposed to touch your money because otherwise you could face penalties for pulling the money before the term of the before the contract is up. So if you're not expecting to touch your money within a certain period of time, certificate of deposit are a good option because they mainly provide guarantee on the interest rate that you're going to be receiving. We already talked about the Trump account, so let me just move forward. And lastly, the last thing that I want to mention is that us who have not family members who have some type of disability, it is always very important that we protect our family and that we anticipate for unforeseen situations. And and one of the categories for those unforeseen situations could be death. So especially if you're the what they call it, the primary breadwinner. If you're the main provider for your home, financially speaking here, it is very important that you consider the option of getting life insurance for your family. Life insurance is not necessarily a benefit that you're getting for yourself. It's a benefit that you're with the end goal of basically protecting your family in the event that you pass away. Um, uh, what's gonna say here? Okay, sorry, I was reading as I was talking. So what I was gonna mention, just very quickly, is the two. When it comes to life insurance, there's two types of there's two categories of life insurance. The first one is called the term life insurance, also known as the temporary insurance. It's a coverage that can go anywhere from 10 to 30 years. And the benefit of having this type of life insurance is that once you pass away, your whoever are your beneficiaries, they will receive the whatever the policy amount is, tax free. So they're not going to pay any taxes on the policy insurance that they receive. So the term life insurance, it is considered to be one of the most basic type of insurance, but also one of the ones that offer one of the greatest tax advantages as well. You, as the policy owner, do not necessarily receive any benefit while basically while you're alive. You don't receive any benefits. The ones that are going to receive a benefit is going to be your family members. The other type of life insurance is what we call the permanent insurance. It actually goes by various names. It can also go by the whole life insurance, universal life insurance, and the list goes on. And this permanent type of life insurance, again, it will be in place as long as you're making the monthly payments. And one of the main highlights about this type of insurance is that depending on the policy that you choose, it may allow you to receive benefits while you're still alive. One of those, for example, is called the Index Universal Life, the IUL. Essentially, real quickly, the way it works is that the monthly payment that you're making, part of it is going to go towards the traditional life benefit, and another portion is going to go into a savings account. Life insurance like to call this savings account the cash value. That cash value is going to increase over time, and at one point you may be able to pull those funds, and essentially you can keep the money. And at that stage, it is considered to receive life benefits while, as the name implies, while you're still alive. You're not necessarily waiting for you to die in order for your family members to receive the full benefit of the actual insurance. Okay, so we have reached the end of the presentation. I want to thank all of you for assisting to today's seminar. So I think at this point we're going to stop the recording so we can begin taking any questions that you might have.